Well, housing finance has been one of the key area of focus for all the lenders. Joining me on FinStreet today is Mr. Keki Mistry, Vice Chairman and CEO at HDFC Limited. Mr. Mistry, FY20 to 23 housing finance companies have seen robust growth. Ticket sizes have also aided the growth. Ticket sizes have grown by 30% in last 2 years. How do you see growth in housing finance sector and ticket sizes going ahead?
My view is that the potential growth for housing in India is enormous for a variety of reasons. I think the headroom for growth, the pathway for growth, the runway for growth over the next not 5, 10, 15, 20, much more than even 20 years is there. No lender needs to do anything which is even remotely irrational because the growth opportunity is there for everyone. Many various factors aid to that. One is penetration levels are very low. Secondly, India has a young population. Every year there are hundreds of thousands of people or millions of people who are getting to the age where they will need to buy a house. And there is a structural growth that I would envisage over the next several decades. Now, what has happened in the last 2-3 years is that the demand for housing is now coming not just from the tier 2, tier 3 towns, it is coming equally strong from the metros. So if you look at the period from 2016 to 2020, I would say latter part of 2016 to 2020, the growth in the metros was subdued. So in that period of time, late 2016 up to, I would say, mid 2020, the growth was primarily coming from tier 2, tier 3 towns. And obviously, the size of a loan in a tier 2, tier 3 town would be lesser than the size of a loan in the metros. So now, because from the mid 20s, the growth is coming equally strong from the metros, you've seen the average loan amount grow. That's the primary reason.
Bank and HFC co-model can exist in future, or will all HFCs with bank as the parent company will get merged with the parent company?
I think it depends on each bank, so I don't think it would be fair on my part to generalize. But I can only say that the demand for housing in India or the ability of housing finance companies to survive in this competitive environment is strong. I don't see any concern. If an HFC is running well, if it has managed its cost of liabilities in a manner in which it's kept its liabilities kept its cost at a very low level and has kept its expenses at a very low level, it can compete equally strongly with any bank in the country. But also a lot of the housing finance companies today are in the affordable housing space, where you generally do not see banks taking a very active interest. So that's a very niche market, which is largely catered to by these housing finance companies. And I think there also the scope to grow is enormous.
You spoke about the liability side. In last 1 year, the cost of funds have impacted NBFCs or HFCs as well. Can now yields improve and aid in net interest margins for NBFCs and HFCs?
So historically, if you look at a net interest margin over the years, forget any particular quarter, they've been in the range of 3.3 to 3.5%. For the year ended March 2023, net interest margin was actually 3.6%, despite the fact that interest rates in the economy went up and RBI raised rates by 250 basis points during the year. So if you manage your asset liability in a manner in which you do not take mismatches, then you can always manage your spreads or your net interest margin within a certain band. And I would always recommend that. I would not recommend a situation to any company, any other housing finance company, for that matter, even a bank, just to artificially look at raising your net interest margins temporarily for a short period of time. You can do that. If you take mismatches in your maturity, you take mismatches in your duration, then you can get a lot of volatility in your net interest margin and in your spreads. When in a higher interest rate environment, you can see your net interest margin shooting up. In a lower interest rate environment, your margins will come down. We've never done that. We've kept a matched balance sheet, and therefore our spreads and our margins have been stable over all these years. And we've already passed on interest rate increases to our customers. We do not envisage a situation where there will be any further increase in interest rates.
Segmental wise, what is the potential market size for affordable housing segment for the next 2 to 4 years? How do you see growth in construction finance as well, given the fact that all developers are talking of good growth going ahead?
So first of all, coming to segmental, I think the market for the affordable housing space and also for the high-end market space is strong. A high teens growth is something that I would expect on a CAGR, on a CAGR basis over the next, say, 5 years or so. That's my personal sense. Anything upwards of 16 to 19% is the way I would expect the industry to grow with a 5-year view. There will be a quarter or two where it will be lower, and there'll be a quarter or two where it may be higher, but that would be my estimate of the CAGR. Construction finance is a very specialized kind of a lending. I think there will be a time when you will have more companies setting up or companies being explicitly set up with the objective of providing construction finance loans to property developers. You have to keep in mind the regulatory environment whilst you're doing construction finance loans. But yes, it's a very big market to grow. And if you do the business well, the business will always succeed. However, you must understand that there will be volatility in construction finance loans depending on the external environment. Individual loan book growth will generally be steady, irrespective of the external environment, irrespective of interest rates. But construction finance loans can be very volatile, whether it's in terms of asset quality, repayments, sales, interest rates, launch of new products, and so on.
Well, asset quality for all the lenders is one of the best in recent years. With strong demand going ahead, how do you see asset quality for housing finance sector?
Abhishek, if I was to look at the time HDFC started in 1977. So from 1977 till 2023, which is a period of 46 years, over 45 years, our total loans written off on individual loans. I'm not talking of construction finance now. I'm talking purely individual loans, which is the bulk of the lending, 83% of our book. Historically, our loan losses from 1977 till 2023 has been only 4 basis points, cumulatively. Not in 1 year, not in 2 years, not in 5 years, not in 10 years, in 46 years. So the total loans we've had to write off, divided by the total amount of loans we've disbursed to individual customers, is only 0.04% cumulatively in 46 years. That's the quality of the individual loan. And I would say this is a testimony of our appraisal method. It's also a testimony of the honesty and the integrity of the average Indian customer, whether it's a middle-class customer, a lower middle-class customer, or a higher middle-class customer.
Well, that's the word coming in from Mr. Keki Mistry that HFCs will see growth in affordable housing and construction finance going ahead. Thank you for all the answers, Mr. Mistry.
Thank you so much. Thank you.